So one of the big stories really for this cycle obviously has been, the U.S. slowing down from fiscal stimulus, the Fed, how far will it go, et cetera. But China has really been a very big story kind of in the background. And, we all think about it in terms of, the trade tensions, et cetera. But the Chinese economy has slowed a lot. And they are limited in terms of what they can do to stimulate, fiscally, monetarily, and we have this whole thing about the impossible trinity, where if your currencies are linked, you're limited by how much you can ease monetarily if the other country that you're linked to is tightening, which of course has been the case with the Fed. So China's really been in a tough spot in terms of not being able to get a lot of multiplier effects out of its economic and monetary stimulus. So probably the best gift that the Chinese can get right now is, obviously on trade, if trade talks do lead to something. But really the best gift is for the Fed to just hold off. I doubt the Fed is going to ease anytime soon, but it probably will just sort of go on a long pause here. And that will give the Chinese government really some more breathing room to kind of get things going on their side. And I think this RRR cut is not a coincidence that it's happening right as the market is expecting far less from the Fed. Actually, the market is now pricing in rate cuts from the Fed. So the timing makes a lot of sense from that perspective.
Jurrien, is it fair to say that with central bank actions right now, or the perception by markets that our own central bank here in the United States is perhaps going to hold off, does that make the macro picture better or worse in your mind?
I think it makes it better. So the markets, the way I look at valuation, the markets are driven by two things: earnings and interest rates, or earnings and liquidity conditions. We know that earnings growth is slowing. It was 24% in 2018. The consensus right now is for about 8.4% in 2019. That number will probably come down because it tends to come down anyway over time. And my best guess is around 5%, but maybe there's even some downside risks to that after what we just saw with the PMI yesterday, falling quite a bit. A lot of economists will kind of plug that into their models and say earnings growth may actually be closer to zero. I'm not quite ready to go there, but that's one part driving the markets. But the other part is the liquidity environment. And if the Fed is overly restrictive in its policy, then that's a negative. And I don't think that the Fed is overly restrictive here, but whether the Fed presses ahead and keeps raising rates or continues to run down its balance sheet, even though the markets are kind of screaming, don't do it, that certainly has an impact. So if the Fed decides to pause, I doubt it's going to ease anytime soon, but although actually, historically speaking, the first ease actually comes fairly quickly after the last tightening, so it certainly wouldn't be unprecedented. But what the Fed does here, both on the balance sheet side and on guiding the markets in terms of rate policy, is a very important input, especially now where we don't get that automatic benefit from accelerating earnings growth, because earnings growth is now decelerating.
Jurrien, let's key on that for a second. Earnings growth is decelerating. So we've seen valuations for U.S. markets and prices for U.S. markets come down tremendously over the course of the past few months. Does that mean that the U.S. is now an attractive stock market to be in relative to others?
I think so. This all comes down to kind of the value proposition as an investor of what does the stock market offer. And when we're in times where there is less uncertainty, investors generally are willing to bid up for each dollar of earnings through a higher PE. And back in January, when there was perceived to be less uncertainty, the trailing PE was actually at 22 times earnings. Today, it's at around 15. So a very significant derating evaluation. So the question right now is, we don't know what the Fed's going to do. We don't know how much earnings growth is going to slow, but at the same time, we're getting a 14, 15 multiple for each dollar of earnings. And to me, that seems like fair compensation for an increased amount of uncertainty, especially considering that inflation remains very stable and very low at around 2%. If you just take the rule of 20, which is just a rule of thumb, if you take 20 minus the inflation rate, you get kind of historically where the PE has tended to be on average. That would argue we should be at an 18 multiple, and instead we're at a 14 to 15, depending on whether you're using trailing or forward earnings. So PEs are down 28% from the highs in January, and to me, that is fair compensation for a little bit more of a cloudy outlook.